Good morning, everybody, and welcome to the second in this series of webinars from IMAP. This is a series about making a success of a managed account program. And what we've done is assembled a set of organisations who individually run very successful managed account programs, either as investment managers, MDA providers, portfolio managers. And we're going to be talking through the series about the establishment issues, which we covered last week. Today, we're going to be talking in much more detail about some of the investment issues and the way of managing those investment issues. And then next week, we're going to be talking about the ongoing management of a managed account program. So thinking about this from the context of a sponsor, if you like, of a managed account program, typically a licensee or a practice. So what we will have covered in the 3 weeks are the establishment issues, investment management issues today, and then the ongoing management of a managed account program, whether it's an SMA or an MDA. And today we're going to be talking about both structures. Other events which we have coming up, which may be relevant and of interest to you, apart from next Thursday, next Tuesday we have a showcase for the best managed account providers, the winners of the IMAP Managed Account Awards. We'll be hosting a session in Sydney at the Amora Hotel in the afternoon to showcase the winners of last year's IMAP Awards. And then for those of you in Sydney and Melbourne on the 11th of March in Sydney and the 18th of March in Melbourne, we'll be hosting the Portfolio Management Conference, where we get to talk in more detail about the specific issues that affect investment management within a managed account, followed by a private markets masterclass in the afternoon, where we'll have 4 of the leading providers of private market, private credit or private equity opportunities, talking about how private markets fit into a managed account context, the role they play in portfolios. I need hardly tell you how to ask a question, but we encourage your questions. And last week, in fact, we had quite a number of questions that were interesting and relevant to the establishment of a managed account portfolio. So please don't hesitate to send those through. So our four panelists today are Dale Pereira from Pendal, an investment manager, Dan Micallef from Aoris, the winner, as it happens, of our International Equities Award last year, the IMAP Managed Account Awards, and one of the participants in next week's Showcase Australia's Best. Kieran Canavan from Centric, CIO of Centric, and Rob Talevski from Activam. So it's my pleasure now to hand over to Dale. The format today is I'm going to invite each of them to talk a little about what they do, the role they play in a managed account context, and then we'll get into the investment management questions. Dale, thanks very much. Over to you.
Thanks, Toby, and thank you everyone for joining. As part of the bigger Perpetual group, we are an asset manager, and so for most of our interactions is really dealing through either the managed funds that sit within managed accounts, or we do have some direct equity SMAs as well that are either nested within managed accounts or as a standalone solution for clients. But we have recently, over the last 2-3 years, had a lot of interest in the sustainable space, and so we do have a sustainable managed account, and so that's really what I'm referencing here today. And a lot of the questions that we've had around managed accounts, and this session is around implementation and some of the nuances And I guess, sustainable probably has more than its fair share, especially with the further definitions required by either ASIC or RARE in terms of certification. But more importantly, just, in terms of greenwashing and having that ability to do full look-through analysis, it's in a managed account, it becomes even more difficult. So, some of the issues here on this slide really reference that. Some of the things that we think about, and we can delve into it today a bit further on in the discussion. But, overall, the key things I think are, ability to be able to define a sustainable objective and follow through across all asset classes, the ability to actually do some stewardship and some voting to enable engagement within all asset classes, and then sort of that balancing the risks returns versus, making a positive difference. How do we adjust that? Also, the costs, it's always a big thing. At the end of the day, the total cost to the client is critical in the adoption of managed accounts. And so making sure that you could still keep that cost down, but, not sacrificing either the return or the sustainability objective, makes it even more, another level of difficulty within a managed account. And then the last one is the style biases, which come through when you're selecting a sustainable portfolio due to the negative screens in some of the sustainability elements. How do you manage that within a managed account where, versus a managed fund where we could traditionally use derivatives or other types of exposures to balance that out? And how we think about that in a managed account context becomes, much more nuanced, but it is very important consideration. Thanks, Toby. That's all for me and start off with.
Thanks very much, Dale. And now it's my pleasure to hand over to Dan Micallef to introduce Aoris. As I mentioned, Aoris is the winner in 2024 of the IMAP Managed Account Award for Global Equities, and he's going to be talking to us, introducing Aoris briefly in that context. Dan, over to you.
Thank you for the kind words, Toby. So my name is Dan Micallef, and I'm one of the founding members of Aoris, along with our CIO, Stephen Arnold. We launched the business in late 2017, and we manage sort of just under 2 billion on behalf of family offices, private wealth firms, and financial planning groups. We set up the business, I guess, very differently to the majority of the index in the fact that, majority of the industry, I should say, in the fact that we only have one product. We're a single strategy business. But to Dale's point, there's sort of various ways to implement the strategy, and that might be simply through the unit trust. However, there's been a certainly growing interest in end clients owning the underlying securities of the strategy. So we also make the strategy available as an individual managed account in-house, and also available as an SMA on various platforms. We're fully, as I said, we're fully dedicated to a single strategy, and that strategy is a highly selective, long-only international equity fund, and it's very much a quality first value style. If Toby's able to just pull up the portfolio, I think one of the key ways that people use our portfolio is certainly where advisors might either go direct for some of their global exposure, or use passive indexes, or even just use managers that typically hold a lot of some of the, like the Mag 7 or top 20 names. So we tend to offer a very much a differentiated portfolio, which accesses a very different part of the market, but still being able to generate excess returns over a cycle. So perhaps I'll just leave that there, and then I can pass on back to Toby.
Thanks very much, Dan. Now, Rob Talevski from Activam will not be known so well to so many of you, but Activam is a leading portfolio manager, Melbourne-based. Rob, over to you. You're on mute, Rob.
Of course I am. Can we just jump to that next slide, please? Okay.
Yep.
One after that one. Okay, perfect. So I'm the founder of Activam Group. We've been around for just short of 9 years. Who are we? We're essentially a multi-asset fund manager and asset consultant We mainly, I guess, we partner with practices on providing managed account solutions and other related services. Our approach, you could sort of describe it as tailored, high touch and more consultative. We run about 5 billion of assets in our managed accounts and across our consulting clients. Next slide, please. These are our founding principles. They also, I guess, highlight how we differentiate ourselves from our peers. Again, the key thing here is we tailor solutions for clients around their sort of managed account solutions. We are, in our investment approach, we're a bit different. We're much more asset allocation focused when it comes to managing managed account portfolios. We're a little bit more, I guess, what you call boutique, fewer, more meaningful relationships. I guess that one of our key sort of objective is to maintain a strong track record of outperformance relative to, I guess, an average balance fund. So we've got a higher, I guess, focus on outperformance. We also support alternative investments. We've had alternative investments, I should say, in the portfolios from day one for the last 9 years. We are independent and we're also, I guess, mindful of costs. Next slide, please. Yep, that's our team there. I guess you could call us top heavy in the sense that there's a lot of experience per person there. And Christina, who's an ex-advisor as well, also, I guess, runs our head of strategic partnerships. So I guess having someone who used to run a practice successfully also, I believe, gives us a bit of an edge when it comes to, meeting the demands and objectives of financial advisors. Here's just a little snapshot of the typical clients we have. And again, they're all a little bit different in their managed account journey and solutions. Michael, who runs the Hopkins Group, he has his own MDA that we partner with, we manage. So tailored solution, white labeled the Hopkins Group as well. Jared Page, who's who's invested in our pre-built SMA portfolios, and then Chris Harris, who's the CEO of Excel Super in Adelaide. He has a white labeled SMA with a direct equity focus that we manage for him as well. Our solutions are sort of broken down into buy, which is sort of having access to our pre-built models across all good platforms. White labeled is essentially for the practice to be able to white label that solution as their own. And we also offer a build program where it's either a combination of our ideas and an advisor's ideas or something completely different. So I guess the word flexible comes to mind there. And I mentioned our numbers as well. I guess, we've had a good, reasonable track record in recent times and over the last couple of years. And, we're focused on continuing that outperformance going forward.
Right.
That's it from us, or from me, I should say.
Yeah, thanks very much, Rob. And finally, one of the original participants in the managed account market, Kieran Canavan from Centric.
Hi, everybody, and thank you for the opportunity to have a chat here today. Really appreciate that. Toby, we can just jump onto the first slide that I have. So I'll keep this relatively short about the firm. So just a little bit about the firm. You'll see the use of the name Centric, which is where the investment team sits, but that's fully owned by Findex. I'll talk more about the Findex group. We're an integrated advisory firm across accounting and wealth services in Australia and New Zealand. We're the 5th largest accounting firm behind KPMG, but unlike the big four, we specialize more in SME and private businesses, although across capital cities, but also regionally. So about 110 offices across Australia and New Zealand. In wealth and SMSF, we have about 28 billion or over 28 billion in FUM. In wealth, there's about 17 billion and around 10 billion of that is in MDA, so managed discretionary portfolios. So that's really what we've been running. I've been running that now for quite a bit over a decade. We started with managed accounts, actually even before that, but in one of our firms that we acquired. If we go to the next slide, just to give you a bit of a sense of where I sit and where our team sits, this is really the value chain from our wealth business. where the first part is what you can see in there is where Findex Wealth Management sits, where really the advisors sit. They're doing the strategic advice for the clients. And then out of the strategic advice, they're working with clients on what the investment solution looks like for those clients. And then they're using our team in the middle there, where you have the managed discretionary account services being provided, where we're looking at, which we'll talk about a little bit later on, the investment team to construct and manage their MDA investment portfolios. And what we do within our group as well, we also look at the implementation of those portfolios. We believe there's a lot of value in running the investments and the implementation in teams that are very, very close to one another. And then finally, the other professional services, obviously as a large integrated firm, there's numerous service lines that clients can access across specialist tax, audit, lending, all of those things as well. So Toby, I might finish off there on just the introduction to Findex and Centric and where we sit. Thank you.
Great, thanks very much. So if I can invite all the panelists to put their cameras on, let's start off with our first question, because what we have here on this panel is really a great depth of experience running across all forms of managed account, MDAs, SMAs, portfolios, individual asset classes. So let's start off with a basic issue. So Kieran, like Findex, Centric, large advice organisation, and of which you're the CIO. So with a diverse client base, what do you see as the framework for the investment elements in the managed account program?
So Toby, we'll refer to two slides on that particular question. If we could go to the slide number 3, I think it is. It's just easier for people to see that. So I'm not going to go into a ton of depth. Hopefully people can download these slides. But we look at it in 2 levels. So first of all, I'm looking at it at the higher level. So what does our MDA investment ecosystem look like? The number 1 there is really the governance overlay, the compliance overlay. And we think that's incredibly important. So that's where our investment committees sit, compliance committees sit, etc. Couple of notes just on the investment committee. We think it's really important to have highly skilled independent members. So we have independent chair, independent members, but we also have advisor members. And then we have compliance and obviously the CIO office as well. The only other thing I would suggest that's probably really important on the governance side of things is if you've got independent members in there, we make sure that they have genuine ability to make decisions, and we give them a veto right. So any of our independent members can actually veto anything that's going through the IC, any of the decisions. And those include, as you'll see on the bottom there, asset allocation, portfolio construction, investment selection, and approved investment. So right across that. The second column that's there is for us really important. That's how we deal with asset consultants. So for us, getting access, because we if you look at how we run our models, which I'll do on the next slide, we've got SAA, TAA, portfolio construction, et cetera, et cetera. We want to be able to access the top consultants across the world where they have got extremely deep experience, but also a lot of information and data that we can access. So primary consultant for us is BCA, which is one of the largest research firms in the world. We then use secondary, more specialized, and this is typically in certain areas, JP Morgan and Goldman Sachs. And then we also use strategic asset allocation. We use State Street. We actually started with State Street in 2013 using Boston Associates Global Associates out of Boston. And then the third part is actually the investment team. And I won't run through all of those, but we've got not only model and investment functions within the team, but we also have a function of advice where we deal with the advice practice, which is really important to understanding that advice. And then there's a governance and oversight, which includes policies, procedures, all of those sorts of things, then APL and funds support. So that's at a high level. We think those are the main components of the MDA investment ecosystem. If we just quickly drop to the next slide, Toby, I'll run through really quickly. This is really looking at it now once you're in level 3. So in the column number 3, you're in the investment team at a really high level. What we're looking to do, if we go from left to right, is designing, objectives, taking objectives into strategic asset allocation And for that, what we're looking at doing is we look at strategic asset allocation as an anchor. We're looking at capital market assumptions, also establishing constraints. So, public office super, you've got liquidity constraints, etc. And then we come up with the asset allocation framework. Typically we use the big consultants with us for us on that. And then we're looking at how do we do portfolio construction. And that includes tactical asset allocation, all the manager research, and then how do you blend a portfolio? So how do you blend a portfolio to get the very best outcome across strategies, managers, etc. And then the third part of that is ongoing management and reporting for us, which is really looking at forward market assumptions. And that's we work with asset consultants very rigorously. Portfolio analytics, so you actually understand what's going on in the portfolios, full look through on what actual investments are being held by managers, what risks are being taken, and then implementation and rebalancing is critical as well. You can be halfway through a rebalance and the macro market changes. You've then got to help the implementation team decide what to do, etc. So I might stop there. I don't want to take up too much time, but happy to take offline questions.
Yeah,
thanks, Toby.
because in fact, many of the points which Kieran has touched on there and in process, we're going to go through later on. Now, with the rest of you, I mean, to what extent does the Centric process align with your own, Robert, perhaps, because you do run diversified portfolios? Mute. You're on mute, Rob.
Toby, I was just going to say, is the question that you're asking about how flexible we are?
More that sort of thinking that that Kieran's outlined is sort of consistent with your own approach to the way you think about building portfolios and implementing them.
Yeah, obviously, we have an investment committee. We do our research internally. We do the asset allocation that we review is internal. I'm sure Kieran also has a view around asset allocation, manager selection, portfolio construction. Yeah, absolutely. There's some similarities there in terms of, I guess, what Kieran does. Maybe the slight difference is we probably do a little bit more of that on our own, I guess. But again, that's that probably is a small difference. But there are similarities there in terms of portfolio construction and how we manage portfolios as well.
And Dale or Dan, I mean, given that you're focused on a single asset class rather than the broad issues, how do the sort of basic assumptions of strategic, capital market assumptions and a sort of a broader context play into the way you think about building portfolios? You're both on mute.
Yeah. Do you want to jump in, Dan, first? I can.
Yeah. Look, I think for us, we wanted to build an investment management business, which we'd like to invest in a fund ourselves. So I think for us, for different parts of the market have different needs. For some managed account providers, the unit trust is just easy and simple. And then for others, they, as I said, maybe where they've got particularly high net worth clients that would like to have their own cost bases or prefer more transparency on underlying holdings. They prefer an SMA type approach. But as far as the process of dealing with consultants, it's quite consistent. There's typically an asset allocation view, research into management selection, and then the hard job for Rob and Kieran is to then blend that all together, because in our space, as I'm sure Dale can tell you, there might be 300 global managers available, 30 might be good, and you've got to pick 3 or 4. So that's where the consultant has that job and can help the advisory space.
Yeah, that's correct. I just had one more thing. I think the key is knowing your clients, so understanding what Kieran or Rob are after in terms of their capital market assumptions, which vary, or they may be wanting some more dynamic asset allocation views, and then how we can help them in terms of implementation. That's what Kieran was mentioning. I think that's critical. Like there is with the managed account structure, there is a greater need for transparency to the underlying consultants or the portfolio constructors. making sure they understand, because it is continuously moving. So like fund managers have a view, they implement them, not necessarily in the same timeframes as the underlying, managed account may wish or may do. So, we want to make sure that we're keeping the consultants and clients informed. So if they're making a call from a macro top-down perspective, may go against what we're doing on a bottom-up perspective, but so they can then obviously tilt their portfolio accordingly. So yeah, I guess it's more of a dialogue you'd have than a more traditional sense of you're putting your fund out there and people are investing and you're not understanding exactly how it's put into a portfolio construction context. And that also helps, I think, in terms of us being able to, I guess, make sure that we've got the right strategies for the right clients, which is another critical element, making sure that.
Well, actually, that's sort of a natural segue, Rob, into thinking about because you have a multi-client base, whereas Kieran is focused on the Centric and Findex client. So for you, as a multi-client consultant, independent consultant, to what extent does the perspective that each of those clients bring, how's that accommodated in a portfolio management process for them? You spoke about 3 clients, for example, at the start, who presumably have different portfolios.
It's a valid question, Toby, and it's something that we've had in our business, I guess, from day one, where we feel as though offering practices something that's more suitable to them helps the buying process. So, we offer flexible solutions, whether it's a pre-built model that they want to get access to, whether they want to white label that pre-built model and help their value proposition, I guess, with respect to when they're investing their clients, or they want a partnered model where they have a very strong view of a certain type of investment or fund, but however they want to use sort of our other solutions around that, whether it's a direct equity component, for example. So, and obviously building it from scratch. So I think from our perspective, offering something of an option of those 3 or 4 helps that advisor choose, and it supports their value proposition as well when they're investing clients' money. In terms of, I guess, that, and it's a point around, imposing the view, and I think that's something that we are mindful of, and we sort of, I guess, we follow what we call a consultative approach. We can get it wrong from time to time as well, and I think it's important for us to be able to sort of provide good rationale for when we, make changes to the portfolio, provide evidence and data behind it as well. And, we don't always see eye to eye on everything, but from our perspective, it's just to make sure that at least they understand where, our view. And, most importantly, clear communication is really important as well. Having a view and providing that rigor behind it is important from our perspective.
And so, Kieran, because you are so closely associated with an advice business, with a well-developed advice philosophy, I mean, how does the portfolio construction process, the investment management capability, align with the advice philosophy or the advice service offer?
Yeah. So I think, Toby, for us, it's actually pretty simple. Obviously, it's a lot more simple than what Rob has because we are internal, so it's a lot more simple. But for us, it's a well-trodden path that, it relies on some key structural processes and then also day-to-day integration between the advice and investment teams. So let me give you 1 or 2 examples that may highlight that. So for us, this absolutely starts at the top. So the CIO office reports through to the main board and also sits on the other boards. So from a firm strategy point of view, top down, the investment services are aligned with the business's goals and objectives. So that's the first part. Second part is our own investment governance overlay, which is the IC. The IC is a committee of the board, and then the IC has advisors on it, and it has the compliance teams, which are 2 of the most critical teams in deciding how advice is provided, what is the service proposition, etc. So you bring them into the decision-making process when you're actually building these models and making the decisions on what you're doing. And then, generally day to day, the investment team sits between the advisors, integrated with the advice processes and issues. So our teams are integrated. If there's ever an issue with a client, we're integrated in how that's solved, etc. We meet with the clients. But as I said, it's a much simpler situation than what Rob has. So we are privileged that we can do it at that sort of level.
And so, I mean, one of the concerns that you hear from advisors is, oh, well, the clients think I'm doing that. That I'm making investment decisions. It's probably less of an issue for you than it would be, for your organization than it would be for others. But does that ever come up as an issue?
Yeah, it is. It used to, especially because we only started the journey to manage discretionary accounts across the group probably in 2010-11. At that stage, most of the advisors, their proposition to their clients was an investment advisor. So part of that was actually how we changed the structure of how we charge advice as well. You're not taking away from the advisor anything. You're actually strengthening their position that they do more strategic advice. So we split our advice fee into a strategic advice fee and a PCNM, or portfolio construction and management fee. That portfolio construction and management fee, advisors were trained how to deconstruct that with the client, which is the part that the advisor does, which is looking at the client's goals and deciding what portfolio to use, how to structure those investments, looking at tax issues, CGT issues, all of those things. And then there's an investment team that actually does all of this. So there's an IC, there's external international consultants, a professional investment team. They do that. The great thing when you actually do that is you can actually charge a lot more for it, because clients will pay, or anyone will pay, if they perceive value. So when you can better explain everyone in the value chain, you can explain the strategic advice, you can explain the work that the advisor does on the investment, then you can explain the work the IC, the investment team, all of those people do, you actually have a better proposition in our view. And that's what changed it for us, because it really helped the advisor better articulate what they do. And it doesn't take away from they doing, it actually strengthens what they're doing.
Now we've had a couple of questions come in from the audience, but if as you're listening to this, there are questions which you'd like to ask any of our panelists, don't hesitate to pop them into the Q&A. So look, so Kieran and Rob, I mean, we've got two investment managers here on the call as well, who are hanging out for inclusion in the portfolios. I mean, Rob, what are the things that you're thinking about when you're selecting investment managers?
Yeah, look, I think the key sort of overarching thing is we're looking really for managers that show the highest probability of outperformance relative to their benchmark. I mean, I know that's the holy grail. That's what you're looking for. Under that sort of, I guess, thing is, things that we look at, obviously track record, probably rates at the top in terms of importance. And it's understanding, that track record, if it's a good track record, why have they outperformed, or even why have they underperformed? I think looking through history, chopping it up into various different timeframe cycles, risk adjusted, so track record, obviously. Investment process, clear, robust investment processes are another important thing that we look at in managers. We like a proven, stable team. We like a team that's been through different cycles, and stability is obviously important as well. Cost-effective solutions, I think that's probably something that's come through in the last couple of years as well, where although those factors are important, you don't want to be overpaying for something as well, from a strategy that might be, related to a different type of a passive, for example. Transparency and governance as well, very important, understanding the governance side of things, and other things like true to label as well. Like if we like a value manager or growth manager and they're tilting across to the other side, then I guess we need to be aware of that as well.
Yeah, and so Kieran, what about for you, given that you have probably a sort of somewhat different client base that you're serving than?
Look, it's not too different. And Toby, I expected a question on this, so we do have a slide which you might bring up in the background, or people can download it. It's the very last slide. We took a punt on that, so maybe I'll just talk about a couple of things here as you bring that up. So we would say really it's really about, at a high level, 4 Ps for us: people, process, performance, and price. And there are some key operational aspects around, things like business sustainability, key man risks, those sorts of things that we pay particular attention to. One of the things, for us, one of the really good sweet spots is a manager with about 3 years track record, good performance, assets growing, but still well below capacity. So that's just that's a generalization, but we have found some of the most amazing managers we've had that have been in there, and that helps. Proven track record, or at least a track record in managing a previous strategy somewhere else. So we're quite happy to do that. If you've got a team that's moved from one place to another, we'll back that team even if it's a seed fund, if they've got that track record. And then, just to break it down a bit further, we look at quantitative and qualitative. We don't think there's a silver bullet anywhere on that. So on the quantitative side, we analyze performance through different market regimes. We seek skilled managers. We find that if someone has displayed skill previously, they're likely to display it in the future. If they haven't previously displayed skill, they will not display it in the future. We also look at managers that have added alpha consistently through different market regimes, things like that. So that proven track record. On the qualitative side, some of the things we look at there, we don't like high staff turnover, especially in the key decision maker level. We don't like high key man risk. That's an issue, and we've seen that being problematic. Business sustainability risks around large losses in fund, and that could be, and I'm sure everyone here knows that there's one fund manager that ran foul of issues with the SEC, and their FUA, it's been dropping very, very, a big international manager. Those sorts of things really worry us. So we would, that would be a problem for us going into that, but it's something that we would look at it potentially coming out very quickly. That particular fund manager has now lost a lot of fund, but they're starting to have the big sort of pension funds like CalPERS remove money as well. We don't like poor compliance or any breaches or opaqueness and non-transparent strategies. So black boxes, we avoid those. And then the other thing is avoid strategies with high assets under management relative to the area that they're in. As an example, if we see, and this is Aussie small caps, not international, but Aussie small cap manager with a lot more than $1 billion in assets, it's very difficult to understand how they're going to outperform, as they really don't have the capacity to do that because they're probably over capacity. So those are just some of the things on the slide there, just some of our processes. But I dare say, what Rob and them are doing, we're pretty much almost the same sort of things we're looking at.
Yeah. So Dale and Dan, I mean, you've heard your target market tell you what to do. I mean, how do you as organisations kind of face in as an investment manager, again, remembering we're thinking about a managed account context, face into those sorts of requirements?
Yeah, I mean, I think we've been doing managed accounts now in the equity space for almost 2 decades in different formats. So we have a lot of experience. I think some of the challenges are around the need to have, your process differentiated from how you run your managed fund. There are nuances with every platform in terms of implementation, but also in terms of delivering communications. And so, one of the things that we discovered early on is, the way you trade, the way you implement is different. You can't be as nuanced as you can in a managed fund in terms of small allocations or implementation over time, or even different ways of book building. So that's critical to understand that. And it's a different skill set in terms of portfolio construction. So making sure you understand that, what the implications are of taking, larger incremental positions versus smaller ones. And also, from a communication standpoint, it's critical that the flow of information is a lot more transparent, a lot more consistent, a lot more timely to a managed account relative to a managed fund. A managed fund, you might do a quarterly fact sheet or a monthly fact sheet, and maybe even 6 monthly. It's not as important for the end clients, but from a
well, it may be just as important. It's
yes,
just,
but it's just the demand isn't there as much. But as a managed account, one of the key value propositions is that transparency, is that ability to see through the portfolio. So for the managed account providers, from a managed fund perspective, manager investment perspective, providing that transparency, trade notifications within a timely manner, portfolio changes, asset allocation changes, anything that even manager view changes, anything that can be seen as a value add to the end client in that structure is beholden on us as investment managers to provide that to our clients.
And Dan, I mean, in the global equity space, I mean, it's always seemed to me to be, a little more challenging in the sense that concentrated portfolio in multiple markets gives rise to quite a number of challenges. I mean, how does Aoris address those sorts of implementation challenges, which Kieran and Dale have touched on? What do you think is a sort of entry point for investors, for example?
Yeah, I think just probably taking a little step back, I think I second a lot of what Rob and Kieran had to say about the manager selection. I think when it comes to for the managers, when they set up the business, things like capacity constraints and maybe setting that up at day one. I think Kieran made a good point that size can become the enemy of performance. So for managers that actually do say, potentially early days, okay, this is where we think we're going to get to, where we think perhaps the interest of the manager and the interest of the end client can diverge because we're going to struggle to get in and out of positions as quickly as we'd like. But then the other thing I'd say, which I thought I think the guys didn't mention, but was alignment. I think another thing that maybe perhaps investors could be asking of their manager is how much skin they've got in the game, and do they eat their own cooking? So that's probably just a couple to add. But as far as transparency, absolutely, I think as Dale pointed out, like we show every stock that we own at the end of each month, but I think that's something that I think the industry is moving to anyway, more transparency, because when times are tough, I think if a manager that's got, call it 30 stocks, is only showing their top 5, then I can understand why people get a little bit uneasy as to, well, what's actually in the rest of the portfolio when it's not doing so well. So the managed account does, offer the ability to have full transparency. And typically, if there's portfolio changes, we can be, we can provide commentary a bit quicker than, say, waiting for the end of the quarter, which we typically provide more detailed analysis. As far as global concentrated portfolios in managed accounts, I would argue that particularly for the sort of financial advisory space in Australia, I think it can actually benefit advisors in the sense that typically concentrated portfolios, particularly if they've got a sort of long-term business owner mindset, they're going to have a lower turnover. And with lower turnover and less stocks, you're going to have lower transaction costs. So, I think that's something to consider. If you're doing a managed account and you've got 50 stocks and your turnover is 30%, well, it's sort of a lot of cost in and out when you're buying and selling that can sort of detract from your performance at the end of the year.
Okay, so what about so just back to the sort of question then of in your asset class, do you think there is an entry threshold for somebody who says, yeah, I like Aoris and I'd like to be in the managed account, not the fund?
Yeah, so for us, we manage a managed account internally, and it's for wholesale investors, and we set the minimum at 250,000. But I do know that when you've got more scale across your business or you're using a platform, that can be lowered, as particularly through an SMA where all the trading's all done at the same time anyhow. But I think 250K, particularly for high net worth individuals, is usually our sweet spot.
Dale, what about you? You've got obviously local portfolios. Do these issues of minimum thresholds become an issue for Pendal?
Yeah, definitely. I mean, I think it's especially when it's combined with minimum trade size. So being able to, sure, you can get a portfolio set, but then when you want to actually implement a trade, it can be quite difficult across smaller accounts. So depending on the platforms, I think for an Aussie equity one, you can get away with, sort of minimum 50,000 FUM. From the multi-asset perspective, makes it a bit more difficult because you've got multiple asset classes there. So if you're doing a nested portfolio where you have the Aussie equities within a larger portfolio, then obviously that requires a larger minimum size because Aussie equity may only be, 25 to 30% of that portfolio. So yes, so I think it's a nuanced answer, but it really depends on how the client's accessing the managed account.
Now, we did get a question through a little earlier, which Rob answered directly to the questioner, but I want to come back to it, which is Kieran and Rob in particular, the sort of somebody who wants to engage with a portfolio manager. I mean, as a licensee, is there a minimum threshold where you go, okay, well, we can't help you if you've got less than 20 million, 30 million, X million dollars, as opposed to buying an off-the-shelf product on a platform. Rob, do you have a minimum? You're on mute again. Yeah.
Got to get this right. We don't have a minimum per se, but what we find is that there's platform minimums. There's obviously managed account managers that have got minimums and trustees. So we find that sort of sits around the 50 to 100 mil, depending on the platform. From our perspective, I guess, when we look to partner with a group, they don't need any more pressure to obviously make this work. We look at ourselves as a solution to support them through the growth and obviously give them what they need to make their managed account journey a success. So again, to reiterate, we don't have a minimum per se, but I think realistically 50 to 100 probably based on platform requirements is where it sits.
Now, I want to come back to one of the other questions which came through, which had to do with fees and fee structures. And Kieran, you touched on this when you were talking about the way in which Findex presents its fees to clients. So the question specifically had to do with our advisors, including a portfolio management fee or a fee within investment portfolio costs. But do you want to go back and just go back again over the point you made about the way in which Findex presents its costs to clients and the way those are characterized?
I can do that, Toby, and we can also do a separate email after this, just giving a bit more clarity and just put maybe a diagram together. But so if you think about the investment, the proposition to a client, so you think about the wealth proposition to a client, an advisor is going to provide strategic advice. And the way we've broken up, we said, well, the advisor should charge for the strategic advice. That could be based on a percentage basis. More likely, it's going to be based on a fixed fee per annum, depending on what the amount of strategic advice, the risk of that advice, the complexity, the size of the client, all those wonderful things. Then you've got another component, which is where the advisor is working with the client on what investments they use to satisfy the investment objectives for that client. So a client might have 3 goals. They might be all very different and they might have different amounts to them, but they will need some sort of investment solution, which might be a model, it might be, a sub-model, whatever it is, but it's probably going to be some sort of model that client needs. And it might be a conservative model for one goal, and might be, quite a growth, more risky model for another goal. So if you think about the work that the advisor is going to do at the client, there's a substantial amount of work the advisor is doing with the client to determine what is the best set of assets or model to use to achieve the client's goal, because the advisor wants to make sure the client's got the highest likelihood of achieving that goal, number one. And that's probably one of the greatest determinants of whether the client will actually achieve their goal. Do they have the right investment set today? Then so that's what the advisor is doing from a portfolio construction and management point of view. They're working on that. And there might be things, client might come to you and have, huge amounts of, let's say, Westpac with CGT on it. You don't want to put them into a mandate or a managed account where you have to sell that down, hit the CGT. You might just want to say, well, let's take out ANZ that's in there and put Westpac in. So when we look at that, there is then the work that the investment teams do, then, the consultants, the investment committee teams that are the investment teams, the implementation teams, So what we did is we split that into, we got the strategic advice, and then you got this portfolio construction and management point of view that you got to charge a fee for, and you should charge a fee. Now that fee within Findex is the advisor's fee. So if you think what the advisor's charging and what they're going out and making sure that, you know, they confirm with the client, is that their fee might be, let's say, $100,000 a year or $10,000 a year, whatever it is. Portion of that might be fixed as a strategic fee. That might be $3,000 to $5,000, and another $5,000 is portfolio construction and management. That all goes to the advisor. But when you're explaining it to a client, it's much easier because you can show more value, because you can say to the client, I'm doing the strategic, I'm then doing this connection with you into the what best model to use. Then we've got these other teams that are there. They're corporate expense, but they've got these other teams that are there. You've got an investment team that's there 24/7 looking at stuff. You've got consultants like BCA, State Street, etc. You've got an investment committee with substantial people, substantial expertise on it. You've got all of those things. So when you're giving a value proposition to the client can see there's actually substantial value behind that. So you're more likely to be able to achieve a higher price point if you can show the value to the client. If you just charge them one fee, 1%, say, for example, so it's very difficult to do that. So from a fee perspective, that's the methodology behind those fees, is to make sure that you can articulate everything that's in the value proposition to the client and then roll that up into something that's very logical for a client, which is strategic and then portfolio construction and management. So I hope I've done that some justice.
Yeah, no, look, it's directly relevant to this session in the sense that when I talk to advisors, I mean, it seems to me that they do, if they're in this space, they do two things, exactly as you've said. They give advice, that's strategic. Yep. You know,
that's critically important. I mean, that includes education, that includes holding the client's hand, that includes being there when something goes wrong.
Yeah, but then we do a different thing, and we call that wealth management, and that is actually the day-to-day job, you know, the 24/7 job of actually keeping a mandated portfolio on track, and that has a price and a value, and you know, just as Aoris, Pendal are entitled to charge for what they do, the portfolio management, the investment management, portfolio management process has a cost and a set of.
And depending on how you've structured your firm, you know, some of those things that I've spoken about, there might be internal, some might be external. You might be using Rob and his team in actual fact to do some of that work for you. Yep. You know, so if you're using that team, some of that dollar fee in the portfolio construction manager might be actually going to the SMA manager.
Well, I didn't realize you charged for that stuff. You do?
We don't. The advisor gets the money, but it helps in explaining the value proposition of what the client is getting.
Okay, well, you introduced that that number of $100,000 a year. Let's talk about investment management for high net worth clients and managing. Managing high net worth portfolios. I mean, how different is it? You know, Dan, you mentioned that you run portfolios for family offices. Dale, I'm sure, well, I know Pendal do as well. So let's talk a little about, you know, whether the $100,000 a year clients are different
I think
than me.
From my experience, typically they thinking longer term, which is great. You know, they're less sensitive to quarterly numbers, which is great because it means that I think for investors that invest in a portfolio such as ours, your in time horizon should be 5 years plus. And I think the family office type clients where they've certainly built businesses themselves, you know, wonderful businesses over many years, you know, that resonates with them that we're trying to essentially do the same thing on a much larger scale and not just own one of them, but own 15 of them. But then the second thing I'd probably say is that they're probably a little bit require more detail in terms of updates. So, you know, depending on the size of the family office, it might require, you know, 2 half-yearly updates or quarterly updates. And they're much more likely to probably go down to the stock level detail. Whereas, you know, perhaps for other groups or other channels in the space, it might be more just, okay, they see Aoris as a strategy and they're not really interested in what's underneath that. It's more, how do I blend Aoris in a larger portfolio?
Yeah. So Dale, we started off right at the commencement talking a little about the ESG process, and I know for the sort of people who back the Teals and the Climate 200 people, these can be more significant issues. And let's talk about the sort of the high net worth and their sort of interest in focus on those types of those issues.
Yeah, no, I was going to mention that, Toby. I think there is probably more, especially with concerns around intergenerational wealth and potentially legacy, and even just in terms of the impact their capital is having on a sustainable basis. The one nuance you get with with some of these higher net worth or family offices, or even small institutional clients, is that they have an ability to tailor, which is the benefit of a managed account, in the sense that they may have desire to screen particular securities or particular behaviors of companies. It's an ongoing thing, so it's something that's required continuously. And the other element, I think, is around the reporting and a bit more of an understanding of what companies actually do, other than what you read in the AFR or the Sydney Morning Herald. And so we do have requests for a more detailed understanding of the philosophies, the policies, how they're actually implementing their particular strategies or services. And like, they want to understand the impact that they're having with their capital to those companies. And so, what is it that they're actually doing from a carbon perspective, from a governance perspective, what's their diversity policies like? And so we're lucky to have Regnan internally as our research and advocacy partner. And so, a lot of what they do is provide that education and intelligence to the clients. And so that's probably, to Dan's point, there's a lot more deep dive into the individual stocks, but not just from a valuation or a price, or from a what is the company doing. It's also from a ESG perspective. Beyond what you read, what does that actually mean for the company when they're investing in a new mine or when they're investing in a new manufacturing? Who are their outsource partners? Is there any modern slavery issues? What's their value chain, production chain? And so they can get quite nuanced and detailed, and it's difficult to rely on third-party providers to get some of that information, because it can be lagged, it can be incorrect. And so you have to do the research. It's quite time consuming, but it has to be done.
Now, in the last couple of minutes, I want to come to the last question which we got from the audience, which is your own sort of expectations of where the managed account market is going. We started off, when I think back 20 years ago, where technology was very, rudimentary. We've gone through a very significant product creation space in SMAs. But Kieran, you touched on the issue of tailoring portfolios to clients, and I have a strong personal view in this area, but I'd like to hear from all four of you about where you see this sort of product or tailoring off the shelf approach going in the managed account space. Again, thinking from an investment perspective.
So Toby, I can run. I probably don't have a huge amount to add, because we use a managed discretionary account, because that gives us extreme ability to genuinely tailor. So we can tailor at an IMA level. I think we're starting to see, from what we can see, because we keep a really good eye on the actual managed accounts that are out there, we're starting to see more tailoring coming in from a number of providers. And I think that will definitely help. The other thing that we see is we are seeing the teams that are running managed accounts are much more skilled, highly skilled, well-structured investment teams. That leads to consolidation as well in who's providing these. And then we've just also seen a little bit of pressure coming from the public offer trustees when managed accounts have been run in public offer trusts, especially around some of the compliance regimes, which I think is driving those first 2 points. So I'm probably not the best to give more detail. Thanks, Toby.
Each of the other three, Dale, Rob, Dan, you've all touched on issues of tailoring and portfolio management. Again, thinking about where the managed account space generally, MDAs, SMAs is going?
Yeah, look, Toby, if I can answer that maybe in a broader sense as well, I think there's still plenty of room. I think there's plenty of opportunity for advisors to adopt a managed account in general, and then part of that will be whether they want a tailored solution or they wanted something off the shelf. I find that the slightly sort of north of 300 mil practices will probably want something more tailored, something south of that, they'll maybe want something, a mixture of, whether it's tailored or off the shelf. But I think the bigger picture is maybe worth mentioning. I think definitely there's more, I guess, focus from the regulators on this. I think performance of these managed accounts are also coming under more scrutiny. And I think it's sort of in that same areas as the biggest super funds. You know, there's a lot more about performance and how they're performing and their outcomes. And I think this industry now will also be a lot more of a focus on managed account providers and what performance they come up with in sort of the next, I guess, couple of years. You're right, Kieran. I think definitely more professionalism around teams and more compliance. Also, I think there's, well, as we all know, there's going to be more consolidation, as we've read in recent times, with a lot of the providers as well. But it's an exciting time and an exciting, you know, industry for us to be a part of, and I think there's definitely a lot of growth going forward.
Dale? Dan?
Yeah, I mean, I think the one thing it's pretty clear is there's going to be a lot more tailoring in, but from that becomes, you know, I think we're sort of heading more towards that institutional accounts space where we, you know, the next evolution will be, you know, the total portfolio approach. How do you implement things from a total portfolio versus individual asset classes or even individual strategies? So consideration around things that are difficult to do within a managed account now, like derivatives, over-the-counter swaps, etc., currency hedging. You know, how do you implement it? And also lowering transaction costs. You know, instead of buying and selling managers, is there and paying the spreads, is there a way to incorporate that within a overall portfolio sense in a managed account while still having that flexibility of choosing, you know, how you want to implement and how you want to select managers? So yeah, that's something that we're working with a lot of clients on at the moment. Is, you know, how do we bring that institutional grade that we have into the managed account space in a way that still works for the managed account providers?
Yeah, nothing really to add from me. I think the guys covered it really. I think there's always going to be a sensitivity towards cost. So, you know, whether it's from a, you know, consultant to the managers and then, you know, from the advisors to the consultants. So, you know, with scale, you know, I think that the space is going to be, I think, more attractive to some practices to set up a managed account, and it helps them streamline their business and probably focus on doing what they love doing more, which is probably seeing clients and not worrying so much.
Yeah, my own view in this area is actually we're just on the cusp of seeing the capacity to take the sorts of competencies which each of the four of you bring, and for an advisor to integrate that directly into their personal service offer to that particular client, so that tailoring will be effectively at a client level driven by technology. We're going to get everybody doing the thing they're equipped to do best, which is investment teams making portfolio management decisions, and advisors effectively ensuring that those fit closely to clients. So look, we run just a minute or two over time, which I try not to do ever, but we have. Thank you very much, everybody who's attended today. Just a reminder that next week in Sydney, we'll be showcasing the IMAP award winners, and we'd welcome you joining us on the 26th of February. Next week we'll be on the 27th, as it happens, not the 20th, which is today. We'll be running the third and final of this series on how to create a successful managed account program. Well, we'll be talking about the broader issues of what happens once you've been through the creation and investment process. How do you make sure it remains successful and is accepted and embraced by advisors and clients? And then in March, Portfolio Management Conference in Sydney and Melbourne. So thanks for joining us, everybody, and we'll look forward to seeing you again in the future.
Thanks so
Thank
much,
you.
Toby. Thank
Thank you,
you.
Toby. Thank you.
Thanks, everyone.
Cheers.